Stock market guide for beginners. Picture this. You're scrolling through your phone and see a headline. 22-year-old investor turns $500 into $50,000. You pause and think, how do people even do that? The truth is, most successful investors didn't start with a fortune. They started with curiosity, patience, and a willingness to learn. If you've ever felt intimidated by the stock market, the charts, numbers, or Wall Street jargon, you're not alone. But the stock market isn't a casino or a mysterious game for the rich. It's simply a tool, a powerful one, that can help you build wealth, achieve freedom, and let your money work while you sleep. This is your step-by-step guide to understanding the stock market as a beginner in 2026. Clear, practical, and easy to follow. Let's make investing simple. 1. What is the stock market? Really? Think of the stock market as a giant digital marketplace, like Amazon, but instead of buying shoes or electronics, people buy and sell ownership in companies. When you buy a stock, you're purchasing a small slice of a company. For example, if you buy one share of Apple, you literally own a small part of Apple Inc. And when the company grows and makes profits, the value of your share increases, meaning you grow with it. The stock market exists mainly through stock exchanges, such as New York Stock Exchange, NYSE, Nasdaq Pakistan, Stock Exchange, PSX, London Stock Exchange, LSE. 2. Why should you invest in the stock market? The main reason is simple: to make your money work for you. When you keep cash in a savings account, it grows slowly, maybe 4 to 6% a year if you're lucky. But the average stock market return historically is around 8 to 10% per year, after inflation. That might not sound huge, but it's life-changing over time because of compound growth. Beat inflation, your money keeps its value over time. Own real businesses instead of just saving cash. Build wealth long-term without needing to trade daily. 3. How the stock market works in simple terms? At its core, the stock market runs on one principle: price, l'offre, what people are willing to pay. When more people want a stock, the price goes up. When more people sell, the price goes down. But price isn't random. It's influenced by factors like company profits and performance, global news, politics, or economic data, investor emotions, fear and greed, interest rates, and inflation. There are two main types of investors. Long-term investors. They buy and hold stocks for years to build wealth. 4. What you can invest in. When you open an investment account, you'll notice many options. Here's what they mean. A. Individual stocks. You buy shares of one specific company, like Tesla, Microsoft, or Unilever. High potential reward, but also high risk. If the company performs well, you can earn a lot, but if it fails, you lose. B. Mutual funds. A mutual fund pools money from many investors to buy a diversified basket of stocks managed by professionals. Great for beginners who don't want to pick stocks individually. C. Exchange-traded funds, ETFs. ETFs work like mutual funds but trade like regular stocks. They track an index like the S&P 500 and are often cheaper in fees. Simple, low cost, and perfect for passive investing. 5. How to start investing. Step by step. You don't need to be a finance expert or have millions. You just need a plan. Step 1. Set your goals. Ask yourself, why am I investing? Is it for retirement, buying a house, or financial freedom? Your goals decide your timeline and risk level. Step 2. Build an emergency fund. Before investing, make sure you have 3 to 6 months of expenses saved. You don't want to sell your stocks during a market crash to pay for emergencies. Step 3. Open a brokerage account. This is where you buy and sell stocks, like your gateway to the market. Popular ones include Robinhood, Fidelity, eToro, or local brokers, depending on your country. Step 4. Fund your account. Deposit a small amount, even $100 or $200 to start. The key is to begin, not to wait until you're rich enough. Step 5. Choose what to invest in. If you're a beginner, start simple. 80% in index funds or ETFs, broad market exposure. 20% in individual stocks, your favorite companies. This gives you growth and safety at the same time. Step 6. Automate your investments. Set up automatic monthly transfers to your brokerage account. Consistency beats timing. Whether the market goes up or down, you'll keep buying, and that's called dollar cost averaging. Step 7. Be patient. This is where most people fail. They panic when prices drop. But remember, short-term dips are normal. Long-term growth is inevitable. If you stay invested, history shows you'll come out ahead. 6. Understanding risk and reward. Every investment carries risk, but not all risks are bad. Risk simply means uncertainty. When you invest in a stock, you're taking a calculated risk that the company will grow. The higher the risk, the higher the potential return, but the higher the chance of loss too. That's why diversification is key. 7. Avoid these common beginner mistakes. Here's what often traps new investors: trying to get rich overnight. The stock market rewards patience, not greed. Following hype or social media tips, always do your own research. Panic selling during market dips, that's when professionals are buying. Ignoring fees or taxes. High fees can eat into your profits. Investing without goals. You'll end up lost when the market shifts. A smart investor stays calm, consistent, and focused on the long game. 8. How to read the market like a pro without being one. You don't need to memorize charts or predict crashes. No one can, but you can learn the basics. Ticker symbol, short code for a company, like AAPL for Apple. 9. The power of compounding in time. The single most powerful wealth secret is time. Even small, consistent investments can turn into huge wealth if you start early and stay invested. For example, invest $200 a month for 20 years. You'll have $122,000 per at 10% return. Invest $200 a month for 30 years. You'll have $361,000. So, the difference? Time. The earlier you start, the more your money multiplies. So don't wait for the right time. The right time was yesterday. The next best is today. 10. Building the right mindset. Successful investing isn't about luck. It's about behavior. You need patience. Let your investments grow. Discipline. Stick to your plan during ups and downs. 2. Learn why investing matters. 3. Know what you can invest in. 4. Start small with a clear plan. 5. Diversify and stay patient. 6. Keep learning and growing. You don't need to be rich to start investing. You need to start investing to get rich. The earlier you begin, the easier your financial freedom becomes. By 2026, while others are still thinking about investing, you'll already be watching your portfolio grow, one smart move at a time. So here's your challenge. Before this week ends, open your first investment account. Start with any amount, even $50. Read one investing article or watch one finance video daily. Let small steps create massive change. Because 1 year from now, you'll either wish you started today or you'll be grateful you did. Your money is waiting for direction. Give it purpose and watch your future transform. But here's the deeper truth. The story doesn't end when the market crashes. That's when the next cycle begins. Every financial crisis resets the rules, redistributes wealth, and exposes who was swimming naked when the tide went out. The people who survive, and even thrive, are the ones who spent years understanding how the system really works instead of chasing short-term gains. History repeats this lesson again and again. The Great Depression birthed the modern financial order. The 2008 crash created a new generation of cautious investors. The pandemic crash of 2020 introduced millions to the market, many of whom never realized they were playing with borrowed optimism. The next collapse, whenever it comes, will once again reveal the truth. The market isn't designed to protect you, it's designed to protect itself. That's why understanding macroeconomics, debt cycles, and real value creation is no longer optional. It's survival. Because while most people panic, sell low, and lose everything, the few who stay calm, buy value, and focus on the long-term foundation end up owning tomorrow's world. Think about it this way. Wealth doesn't disappear in a crash. It just changes hands. Every dollar lost by emotional investors is picked up by the patient ones. Every overhyped stock that collapses clears space for companies with real substance to rise again. Every manipulated market eventually purges itself of illusions, and what's left standing is opportunity. So the real question isn't, why is the market high? It's, what will you do when it falls? Because that's where real wealth is built. Not during euphoria, but during chaos. The time to prepare isn't when everyone's already panicking. It's when everything still looks fine. The smart money plans ahead. The rest reacts too late. If the economy feels broken to you, it's because the system was never built for balance. It was built for cycles. Boom and bust. Greed and fear. Hype and collapse. Those who learn to ride these waves rather than drown in them become the ones who write the next financial story.